Welcome to FinWell Daily Brief for Thursday, June 19th, 2025. We've got the market data based on today's close, and we're ready to unpack what shaped the financial world. And let's kick things off with a really interesting financial fact. Did you know that equity savings now make up roughly 9% of gross household financial savings here in India?
That's right. It's a clear sign, isn't it? It shows the growing power of systematic investment plans, SIPs.
Exactly. Even though the flows have, moderated a bit recently, that 9% really tells a story about how the Indian investor is evolving.
It absolutely does showcase a deeper engagement, a long-term trend.
Right.
But today's market numbers, they might paint a slightly contrasting picture, just highlighting how dynamic these markets really are.
So let's get into that contrast. How did the major Indian indices actually fare by the close today, 15.3 IST?
Okay, so the Nifty 50 closed at 24,793.25. That was down just 18.80 points, barely a dip, minus 0.08%.
Almost flat, really. But then we look at the mid and small caps, quite a different story there, right?
A very different story. The Nifty Midcap 150, it closed at 21,022.95. That's down 335.55 points, a significant drop of 1.57%.
Oof. And the small caps?
Even sharper. Nifty Small Cap 250 closed at 16,813.05, down 330.55 points. That's a 1.93% decline.
Wow. And the overall market?
The Nifty Total Market Index, that finished at 12,807.85, down 96.50 points, or 0.75%.
So this stark difference, Nifty 50 holding steady while mid and small caps slide. What's the story behind that divergence we're seeing?
Well, there are a few key things driving this. First off, weak global cues definitely played a big role today. Sentiment wasn't great internationally.
Okay.
And then you have the U.S. Federal Reserve. They're sticking to a pretty hawkish stance, signaling potentially tighter monetary policy. That always impacts global sentiment, makes investors a bit nervous.
Right, ripples across the globe.
Exactly. And domestically, we're still seeing those persistent foreign portfolio investor outflows. FPI selling continues to weigh on our markets, particularly the broader market segments.
And how does this connect to things like bond yields in the rupee?
Good question. It connects quite directly. India's 10-year government bond yield actually rose today to 6.35%. That's up from 6.25% just last month.
Why the rise?
It's pressured by that global risk aversion we talked about, and also rising oil prices are a factor. And the rupee, well, it weakened further.
Oh, how much?
It hit 86.71 per US dollar. That's its lowest point in 3 months. Again, driven by a surging dollar index globally and those continuing foreign outflows. It paints a picture of these external pressures really influencing domestic markets.
Makes sense. So, moving from that broad market view, let's look at some specific corporate headlines that caught our attention today. Beyond the indices, what were the big stories shaping industries?
Yeah, some interesting strategic moves happening.
Let's start with Jio Financial Services. They acquired 7.9 crore shares of Jio Payments Bank from SBI. What does this consolidation signal about Jio's ambitions in digital banking?
Well, this move really strengthens Jio Financial Services' position. It's about reinforcing their whole digital banking ecosystem. By consolidating control like this, they can potentially accelerate their reach, integrate services more smoothly. It's a key step for them.
Right, tightening their grip on that ecosystem. Now, switching to EVs, Hero MotoCorp unveiled their new Vita VX2 electric scooter. But the interesting part is this battery as a service model. How is this meant to work?
Yes, the Boson model. It's quite innovative. The idea is to tackle the biggest hurdle for EV adoption, which is usually the high upfront cost of the battery.
Right, the battery is the expensive part.
Exactly. So by offering the battery as a separate service, Hero aims to significantly lower the initial purchase price of the scooter. It makes EV ownership potentially much more accessible, more democratic, you could say.
So it's a strategy to grab a bigger slice of that growing EV market pie.
Precisely. Lowering the barrier to entry is key, especially in a price-sensitive market like India. It could really help expand their electric footprint.
Very interesting. And then something that sounds almost futuristic. Vodafone Idea partnering with AST Space Mobile for direct-to-device satellite broadband. How significant is this for connectivity, especially thinking about digital India?
It sounds like sci-fi, but the implications are very real, particularly for bridging the digital divide. Satellite broadband like this can reach areas where traditional mobile networks or fiber just can't go, or where it's too expensive to deploy.
So truly remote areas could get connected.
That's the potential. Direct-to-device satellite broadband could be a game changer for last-mile connectivity, really aligning with the goals of Digital India to connect everyone.
Okay, one more item on the news front. Gold prices. They've fallen for the third day straight. 24-karat gold is now around rupees 1,001,080 per 10 grams. Why is the yellow metal losing its luster right now?
Yeah, it's been under pressure. The main reason, again, comes back to the U.S. Fed's hawkish stance. When the Fed signals higher rates, it tends to strengthen the U.S. dollar.
And that makes gold less attractive.
Correct. Gold doesn't pay interest, so when interest-bearing assets like bonds or the dollar itself look more appealing, investors often shift away from gold. So that global bullion price is feeling the heat.
Got it. Okay, let's shift gears now to the IPO market. The Resinfra Solutions Limited SME IPO closes tomorrow, June 20th. What do investors need to know here? It's an SME IPO, price band 43-45 rupees, size about 16 crore rupees.
Right, an SME IPO. And it's crucial, especially with SME IPOs, to look closely at the details. There are a few, let's call them red flags, or at least points of caution to consider.
Okay, what are they?
First, the business itself. It's in the construction and engineering sector, which is, well, very crowded. And their net profit margin in FY24 was under 4%. That's quite thin.
Signals intense competition then.
Definitely. Second, client concentration. This is a big one. Over 60% of their revenue comes from just their top 3 clients.
Wow, that's a high dependency.
It really is. It significantly increases business risk. What happens if they lose even one of those major clients? It could have a huge impact.
That's a serious risk. Anything else?
Yes. There were no anchor investors. Despite, the usual marketing push for an IPO, no institutional investors came in as anchors. Anchor investors often add a layer of validation, so their absence is, well, noteworthy.
Okay.
And we should also remember the context here. SEBI recently proposed raising the minimum investment for SME IPOs from 1 lakh to 2 lakh rupees. The idea is to curb excessive speculation and maybe encourage more informed participation.
So putting it all together, thin margins, high client concentration, no anchors, higher minimum investment. What's the takeaway on this IPO? You mentioned a low moat.
Yeah, low moat basically means the company doesn't have strong, sustainable, competitive advantages to protect its business from rivals. Given all those factors, the thin margins, the client risk, the lack of institutional backing, this IPO appears to be, frankly, a high-risk proposition, especially for retail investors. The potential rewards seem low compared to the risks involved.
Right. Thanks for breaking that down. So with all this information, the market dips, the specific news, the IPO risks, what's the broader market outlook? Are we just stuck in this volatility?
Well, for the near term, volatility does look like it's going to stick around. Markets remain pretty sensitive.
What are the main pressures continuing?
It's that combination we discussed. Ongoing global risk aversion, those stubbornly high oil prices, and the hawkish signals from the U.S. Fed. They all continue to weigh on sentiment.
And the mid and small cap drops today.
That sharp decline is a very clear signal of risk-off behavior. Investors are pulling back from what they perceive as higher risk assets right now. Plus, the weak rupee and higher bond yields just reinforce those external pressures.
So what's the advice for you, the investor, navigating this?
The general consensus seems to be focus on quality. Look towards large cap stocks, which tend to be a bit more resilient in choppy waters.
Any specific sectors?
Defensive sectors are worth considering. Think FMCG, fast-moving consumer goods, and maybe IT. These are often less tied to the immediate economic cycle.
And what to avoid?
Crucially, be cautious with leveraged mid-caps, smaller companies carrying a lot of debt, and, as we just discussed, speculative IPOs. It's probably not the time for excessive risk-taking.
What should we be watching for?
Keep a close eye on further signals from global central banks, especially the Fed. And, of course, track those oil price trends. They'll be key drivers in the near term.
Okay. Now, before we wrap up, there's a crucial warning we need to discuss. Something about dividend stripping scams.
Yeah.
What exactly is this, and why should investors be cautious?
Yes, this is really important to understand. It's a tactic used by some unscrupulous players. Essentially, fraudsters buy a stock just before the dividend record date.
When the price might be slightly inflated by the expected dividend.
Exactly. They buy it then, capture the dividend payout, and then immediately sell the stock, often right after it goes ex-dividend and the price drops. They try to exploit tax loopholes or just manipulate the short-term price movement.
So they're not really investing in the company, just grabbing the dividend.
Precisely. They strip the dividend. And the impact on you, the genuine retail investor, well, it can be misleading. It creates artificial trading volume and price movements around dividend dates, making it harder to judge a stock's true value. It can lure people into chasing dividends without looking at the fundamentals.
So it distorts the market picture.
It can, yes.
Yeah.
The critical advice here is always look at the company's fundamental strength, its earnings, its business prospects, its debt levels, and its long-term dividend history, not just the next payout, before making any trading decisions based on dividends. Don't fall for schemes that seem too good to be true.
Sound advice. Never trade just on the dividend announcement alone. Okay, let's bring it all together then. Indian markets ended lower today, particularly tough for mid and small caps.
Right, feeling the pressure from global factors and FPI outflows.
We saw the rupee hit a 3-month low, gold prices continued to slide, and that Anonfresh Solutions SME IPO closes tomorrow with some significant risks to be aware of.
Absolutely. And the key message remains. In these uncertain global times, it's really vital for you, the investor, to stay cautious. Focus on quality companies and definitely steer clear of overly speculative strategies or IPOs that look risky.
Wise words. Now, if you found today's FinWell Daily Brief helpful, please do subscribe wherever you get your podcasts to stay informed every day.
And if you want deeper insights or need to connect with financial experts, you can always reach out to SOS FinWell on LinkedIn. We'd love to hear from you.
Before we sign off, here's a thought for navigating these sometimes challenging market conditions. Patience is not simply the ability to wait, it's how we behave while we're waiting. That's a quote from Joyce Meyer.
And finally, our standard but very important reminder. This podcast is strictly for informational purposes only. All the market data we discussed is sourced from SEBI-registered exchanges and regulatory filings.
Please always consult with a certified financial advisor before making any investment decisions. Your financial well-being is paramount.